Hi, this is Ryan from Monarch Capital Home Loans, and in this video we're briefly going to talk about 3 ways in which you might be able to lower your monthly mortgage payments. Now the first way that someone might be able to lower their mortgage payments would be just to get a lower interest rate. This is probably the most straightforward way to do it. You could just simply call various lenders and obtain interest rate quotes from these lenders just based off of the information that you tell them. Now, a second way that you might be able to lower your mortgage payments is to get rid of the mortgage insurance premiums that you're paying. A third way would be to get into an interest-only loan, or you could get into an adjustable rate mortgage. So we're actually going to talk about mortgage insurance premiums and interest-only loans. Lowering your rates pretty straightforward. So a mortgage insurance is essentially defined as the premium paid on an insurance policy that provides coverage to a lender in the event that a borrower defaults on a mortgage. This ensures that the lender does not incur a loss if the borrower is unable to repay the loan. So basically, a mortgage insurance is just an extra payment that you have to make on your mortgage on top of the principal and interest that you're already paying. It's usually paid by borrowers who have less than 20% equity in their house. Now, it's very common for borrowers who have an FHA loan to be paying mortgage insurance premiums. And one way to get out of those mortgage insurance premiums, or get out of paying them, would be to get into a conventional loan, and you would have to have 20% equity in your house to completely get rid of your mortgage insurance premiums. Now, if you didn't have 20% equity within your property, you might still be able to completely get rid of your mortgage insurance premiums by taking out a first and second mortgage and going down the conventional route. So there are still options available to you regardless of how much equity you have. Now let's move on to interest-only loans. We're just going to talk about one pro and one con associated with interest-only loans. Interest-only loans are pretty straightforward. They just are interest-only. You're essentially making payments only towards the interest on the loan. Usually you're paying interest only for a fixed number of years. It might be 5 years, 7 years, or 10 years, or something like that. So the pro obviously would be that you're lowering your payment. But the con would be that your loan amount or your balance on your loan would be staying the same. It would not be lowered at all through your monthly payments. So let's summarize really quickly what we've talked about. We've talked about, one, you could lower your interest rate. That would lower your monthly mortgage payment. If you could get rid of mortgage insurance by getting into a conventional loan, or there's other programs that we offer if you don't have 20% equity in your property to get rid of it. Or you could get into an interest-only loan or an adjustable rate mortgage, which we really didn't address much in this video. Well, I hope that was helpful, and this is Ryan from Monarch Capital Home Loans.